You are most welcome to the Insight Empire. This is Blue Bull Forex and yet another powerful video explaining to you how to basically trade ICT concepts, because we are convinced that these ICT concepts are very precise, especially with the entries. If you don't want to lose a lot of money in the market, I would recommend you watch this particular video to the end. My name is Blue Bull Forex and this is the Insight Empire. Of course, you are number one source of forex trading insights. Now today we're gonna be digging deep into two concepts that so many people actually do not understand and how to be able to take advantage of them. Now there is something that most people don't understand even before we come to the context of the day. You don't need a very high win rate. In other words, you don't need to be a genius to succeed in the forex market. You don't need to be a genius for you to succeed in the forex market. You need to have a plan. All right. A genius without a plan can be beaten by a relatively not a very wise person with a plan. And let me explain why. You need something we call risk to reward ratio as opposed to high win rate. All right. I'm not saying win rate is bad, but you need to harness big trades that are going to grant you much more returns than entering some trades which probably would guarantee short-term success, but one step mistake and then you are crushed completely. All right. Take an example of someone who has 1:3 risk to reward ratio. This means on Monday you can get a losing trade, on Tuesday a losing trade, on Wednesday a losing trade. So this means you have lost 3 trades in a week. So you have only 2 trading days. But when you get it right on Thursday and Friday, you are able to compensate for the last 3 days that you lost, because you are only losing 1, but now you are getting up to 3 of what you were losing. That is the importance of having a good risk to reward ratio. Remember, forex trading is not about how much you make, it's about how little you lose. And in the long run, what is going to make you stay in the game further is when you have a good R to R. When you are losing for something very small, but when you are getting it right, you are securing the bag big time. And one of the differences between a profitable and unprofitable traders, basically apart from the strategy, is on how they reason. Okay, successful traders, their reasoning is that they should hold the trades that are good, going to the good direction. All right, so if they get a nice trade, they will hold the setup, and when they are in a losing trade, they will basically close very quickly. Now traders who are not successful do the exact opposite. They close good trades immediately, they enter the profits, and they hold long bad trades until they completely blow everything in that particular account. Now today we are exploring 2 of the 7 institutional reference points, and I'm going to be telling you the difference between the 2. One is called ICT breaker block. What is an ICT breaker block and how do we take advantage of an ICT breaker block? Also, what is ICT mitigation block, because so many people don't actually understand the difference between ICT breaker block and ICT mitigation block. So right ahead, we're gonna go here pretty much and see what is the differences between the 2 and how also to trade ICT breaker block, and also how to trade the ICT mitigation block, how to be able to leverage on the 2 to be able to create a success story for yourself. Now let's dive into the forex market charts easily. Now when you look at this particular, I'm going to make a drawing here. Basically, the forex market moves creating series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and at some point it might descend to completely change this particular pattern, and so it will trade below this particular swing point over here, and then we start another series to the downside. Now when we trade beyond the highest swing point where the market reached before reversal, we call this one a break of structure. This is basic fundamental knowledge. All right, so this one you call it a BOS. Okay, we can clone this one again, so we can manufacture so many BOS. So we can clone that, clone, and clone. So this is a BOS again. This is another BOS. But now, once now we change the character, we stop going bullish, because now this is a market which is going up. A market which goes up is called bullish market. This is a bullish market. At some point, we reverse to the opposite direction. So at this particular point, now we'll talk about a bearish market. And now in a bearish market, we create breakout structures to the downside. So first here we have something called the market structure shift. All right. Some people will argue it's called the change of character. All right, almost the same thing. So this is the market structure shift. Market structure shift basically means that the market has changed its character from being bullish and now it's bearish, meaning that we are going to the downside. Now we break structures to the downside. This is where we are going to have our break of structure. This is going to where to have our break of structure, but now to the downside. Now, if you can see, when we are going bullish, we are breaking structures to the upside, but when we are coming downward, we are breaking structures to the downside, provided we trade below the previous swing point where the market had marked a lower low. Now, this is it. So this break of structure is actually very, very powerful because it is one of the confirmations on whether a point of interest is valid or not. When I say a point of interest, I mean array in this particular context. Now, if we have an order block, if you have not seen my video on how to spot order blocks, actually you can see it in the comment section. My director will be able to show you where you can be able to access that particular video on how the order blocks basically work. So the order block basically, as we argued, is the last candle to print. Assume now this is a bearish candle, and then we have started a bullish move from that particular point, and we are going to the upside. All right, and then we had a movement at this particular point. So this candle to print here, has a wick, and it's very significant. All right. So whichever this direction was coming from, let's assume this market was coming from this particular side. Just a minute. Market was coming, and at that particular point, we had a reversal to the downside, and now we have gone up again. All right. Now, assuming this is the structure of this particular market, as you can see now here, we have the market trading across this particular point which is a swing point, creating what we call a break of structure, a BOS. Now, this last red candle to print here before we end the impulsive move is what we mark from the highest point of the tip to the lowest point of that particular wick, and that becomes our point of interest. Now, this is basically what we call a traditional order block. This is basically what we call an order block. And the idea behind the trading order block is that the smart money does not execute all their orders at once. So they leave some pending orders that they come to recollect after the initial price movement. So at this particular point, we expect the market to go completely wherever it's going. Then once it comes back to our point of interest, then we are going to capture some buys to the upside, having our stop loss just below this particular point. All right, this is where we're gonna put our stop loss just below there and probably target the previous high. And that's why most of the time we'll collect either 1:2, 1:3 to reward ratio. And that's a pretty good way of trading the traditional order block. All right, now this is it. So at some point, this particular order block of ours will get violated. All right, at some point, this particular order block of ours, the market will fail to respect this particular order block. And I want you to pay attention. An order block is a powerful point of interest either way, because most of the order blocks don't fail. They only turn to something else different. Now watch. So at some point, the market will come and completely surpass this particular order block like that. So once it surpasses this particular order block, now we change our bias. Remember, traditionally we were looking for a buy opportunities, but at this particular point, once it trades below that particular point of interest, we wait for a pullback to the order block again, and then we shall be looking now to sell. So this is now our new bias. Short position here. Oh my goodness, this looks ugly. Short position at that particular point. Project 1:2, 1:3. We have talked about risk to reward ratio and how significant it is. Always make sure that your stop loss is just within that particular point of interest. And now this is what we call an ICT breaker block. All right, ICT breaker block. Simple. Breaker block. In other words, an ICT breaker block is a disrespected order block. Hello? An ICT breaker block is a disrespected order block. So once the market surpasses completely from the order block, then it should retrace to that particular point of interest, and then it means it has also helped us to change our bias. So the moment the candlestick closes below the order block, you have already changed your bias because it has already been violated. So you do not have any other hope with that particular point of interest unless the market surpasses completely and then it comes to that particular point of interest, which is still a very valid internal range liquidity. Now, there are two contradicting things that so many people don't understand. And there's what exactly I want to explain today. There is a very huge difference between an ICT breaker block, the one that I just highlighted now, and the next institutional reference point that we are going to cover, which is basically the ICT mitigation block. Now, what we call an ICT mitigation block, this is basically a breaker. Now, an ICT mitigation block is characterized by one, a failure swing. And let me explain what that means. So, assuming this is where we had our initial order block, all right, this was our point of interest, that particular order block, and it happened to have a week. It happened to have a week, and it's an order block, of course. Make it black. So ideally, the market was moving from whatever point it was coming to, and then boom, it reached that particular point. And we happened to have a movement away from that particular order block, creating what we call a break of structure here. That's a break of structure to the upside. All right, that's basically what we call a break of structure. So that's a break of structure. So ideally, most of the times, or sometimes, the market will not create this particular break of structure, and then it will surpass our order block again, and then retrace to an internal range, which is basically the initial order block. Then it continues with the direction of the trend. Now, this is why you want to pay attention to. This failure swing here is the only difference between a breaker block and a mitigation block. Mitigation block means that particular swing point over here is completely covered, or it's completely mitigated by the previous point of reversal. This means this particular mitigation block, it's a point of interest, yes, but there is no this particular break of structure here. So absence of this break of structure is what basically creates the difference between an ICT breaker block and an ICT mitigation block. So I'm going to give you a skeleton of both of them. So we expect something like this in the first case scenario, having our order block at that particular point, and then we have a break of structure. This is basically what we call BOS. All right, and then we have the other case study. We have this kind of a price movement. This one is completely interjected, and then boom, then it still drops down to the downside. And this is where we have our market from. So as you can see, this is break of structure, and the other side there is no break of structure completely. So this is mitigation block. And this other one is breaker block. Simple. If you find this content educating, please remember to subscribe to this particular YouTube channel. That is the only way you can be able to motivate me to do more and more of this particular content. Attached below is, of course, a link that will link you to my Telegram channel, where I offer trading insights of this caliber any day, anytime. Of course, this is Blue Ball Forex, and we will engage in the next subsequent videos. So in the meantime, see you next time in the next video.